All right, let's dive right into this. Welcome to The Explainer. Today we're taking a hard, unflinching look at one of the absolute highest risk endeavors in the financial markets, trying to flip a tiny trading account of less than $100. We're going to break down the exact strategies, the brutal mathematical realities, and the psychological warfare you have to master if you're actually going to attempt this. So buckle up, because we are definitely leaving the amateur mindset at the door.
It's a question we literally see everywhere. You open up any social media app and boom, your feed is flooded with these flashy account flipping challenges. You know the ones. Influencers claiming they turned $50 into 50 grand in a few weeks, usually filmed from the driver's seat of a heavily leased sports car. But look, here's the reality we need to establish right out of the gate. Professional consensus warns that this approach almost always ends in total, absolute account liquidation. Why? Because it relies on extreme leverage and what is essentially just high-probability gambling, rather than actual sustainable business practices.
So here's our roadmap for this explainer. We'll cover the myth, institutional precision, the brutal math, psychological survival, and finally, the prop firm pivot. Let's make that jump from amateur gambling to strict professional precision.
Starting things off with Section 1, the account flipping myth.
It's time to call out the very real dangers of the trading matrix. The myth you're sold is all about dopamine, wildly over-leveraged positions, and pure gambling. But trading a sub-$100 account, that requires a hardcore survival-first mindset. You absolutely have to abandon the gambler's glitch and treat the market like a highly disciplined business. You simply can't afford to treat the financial markets like a casino, because if you do, your tiny capital is going to vanish before you even figure out what hit you.
Moving right along to Section 2, Institutional Precision Strategy.
When you're working with less than $100, you have absolutely zero room for error, and I mean zero room for wide stop losses. You need institutional-grade weapons, specifically smart money concepts. To find those high risk-to-reward sniper entries, you need a strict mechanical checklist. First, identify your higher time frame narrative, like the 1-hour or 4-hour trend, to ensure you're trading alongside the big banks. Second, mark your point of interest, specifically an order block that caused a major break of structure. Third, wait for a liquidity sweep. And finally, drop down to the 1-minute chart to enter on a change of character. Let's really unpack those last two steps, because they are crucial.
That third step, the liquidity sweep, counters something called inducement. Think of inducement as a fake support or resistance level that institutions intentionally create to trap early retail traders. Retail guys often jump in way too early, they place their stop losses right below that fake level, and boom, they get trapped. If you want to survive with a tiny account, you have to literally sit on your hands and wait for the big banks to sweep those retail stop losses before you even think about entering the market.
Once that sweep actually happens, we start hunting for a chaunch, or a change of character. This is a verified shift in the internal market structure down on the 1-minute chart. And here's the secret. You only enter on the retest of this 1-minute chaunch. Why get so incredibly specific? Because this is exactly how you keep your stop loss brutally tight. We're talking just 5 to 10 pips. When you've only got $50 to your name, a razor-thin stop loss is your only shield.
All right, Section 3, the math of flipping.
Now we have to face the cold, hard math of managing tiny capital. The numbers don't care about your feelings, and they definitely don't care about your social media goals. The reality really comes down to one crucial number, $10. Standard risk management dictates you should only risk 1% of your account. But 1% of $100 is a single dollar. Most broker margins simply won't even allow you to place a trade that small. So you're mathematically forced to risk more, usually around $5 to $10 per trade. Think about what that means. You literally only have 10 to 20 bullets in the chamber before the entire account is blown. Every single trade becomes a matter of life or death for your portfolio.
Because of this, typical retail advice completely falls apart on small accounts. Targeting a 1-to-1 or 1-to-2 risk-to-reward ratio is mathematically a guaranteed liquidation over time if you're forced to risk 10% of your account per trade. To survive, targeting A-plus setups that offer 1-to-5 or even 1-to-10 returns isn't just a nice-to-have. It is completely mandatory for survival. You absolutely must win big when you win, because you just can't afford a string of normal losses.
To actually hit those massive risk-to-reward ratios, your execution tactics have to be flawless. You should only be trading during the London or New York kill zones to catch fast, explosive volume. You're going to need to utilize 5-minute scalping strategies. And to really multiply your profits without increasing your initial risk, professional traders use pyramiding. That means adding to a winning position only as it moves deep into profit.
This brings us to Section 4, Discipline over Dopamine.
Now we're shifting from the charts to the mind. The mental frameworks required to stay alive here are honestly way harder to master than the strategy itself. The ultimate psychological mantra you need is discipline over dopamine, or DOD. When you're trading tiny capital, the urge to overtrade is just overwhelming. You want action, you want the big flip, but you have to resist. The secret? You must treat that $100 account exactly as if it were a $100,000 account. Think about it. If you wouldn't take a sloppy setup with $100 grand on the line, do not take it with $100.
I really love this metaphor from Stick Trader. You have to view every single trade as simply one draw from a probability jar. Even with the most perfect strategy in the world, losses, which are the red marbles, are completely inevitable. If you pull a red marble and react with anger and take an emotional revenge trade just to win the money back, you will instantly destroy your small account. You have to accept the red marbles as just a standard cost of doing business.
Unrealistic expectations are such a massive trap here. Chasing 100% weekly returns comes with a staggering 95% failure rate. It just destroys traders. By contrast, the pros at institutions target steady, realistic gains, something like 20% annually. Settling for steady gains is what actually builds lasting wealth. But I know what you're thinking. How do you make real, life-changing money on 20% of $100? Well, you don't. Which leads us to our final and definitely most important section.
Section 5. The Professional Alternative. Prop Firm Scaling.
If you truly want to make a living doing this, you need to abandon the account flip altogether. Direct flipping is mathematically improbable and emotionally draining. Instead, here is the ultimate professional hack. Use your $100 to buy a prop firm evaluation challenge. If you pass by proving you can actually manage risk, the firm provides you with access to $5,000 or even $10,000 of real funded capital. This is how you actually build a sustainable career.
Just look at the sheer absurdity of the math. Making $5,000 in profit by trading your own tiny $100 account requires a completely fantasy 5,000% gain. But if you use your discipline to secure a $100,000 funded account, you only need to make a modest, totally realistic 5% monthly return to make that exact same $5,000. 5% is a normal professional benchmark. 5,000% is a lottery ticket.
Prop firms literally force you to be a professional. They remove the gambler's glitch by enforcing really strict daily drawdown rules. Break the rules and you lose the account. It effectively fixes the human before you can go and lose your actual life savings. And the ceiling for this model is just unbelievably high. Consider these verified payouts. DZ Trades pulling $936,000 in just 25 days. Yush hitting $485,000. Ocala making over $5 million in mobile scalping payouts. That is what true scaling looks like.
But hey, make no mistake. To achieve even a fraction of that level of success, brutal accountability is entirely non-negotiable. You must journal every single trade. Tools like EdgeWalk or EdgeFlow are absolutely essential to finding your real statistical edge. You need to know exactly what your win rate is, what your average risk to reward is, and exactly where you are making mistakes. Guessing is not a strategy.
Which leaves us with the ultimate human glitch test. Ask yourself this. If you cannot be disciplined with $100, if you still over-leverage, if you still revenge trade, and if you continually break your own rules, why in the world would the market, or any prop firm, ever trust you with $100,000? Take some time to really rethink your relationship with risk, embrace the boring reality of true professional trading, and take control of your discipline. That's all for this explainer. Keep learning, keep charting, and I'll see you next time.